the groundbreaking work. It was, I believe, your dissertation down in Hyde Park in Chicago in the 1980s about the yield curve as a predictor of a recession. Give us a quick 30 seconds on that, and let me ask you a question. 2019, the yield curve inverted, and the narrative was, oh, it's not going to work this time. The economy's fine. Then we got COVID. Oh, you got lucky because you got this amazing pandemic, or not amazing, but you got this pandemic that made the yield curve work again. What would be, first of all, how does the yield curve predict the recessions, and would it have worked anyway, based on what we saw in 2019 and with COVID getting in the middle of it?
Sure. So it is remarkable to me that so many years later, we're still talking about my dissertation. I haven't published on this idea in over 30 years. So the idea is a pretty simple idea that asset prices contain information about the future. So think of a stock. Well, that is just the present value of expected future cash flows. And those cash flows are highly dependent upon what happens in the economy. So it turns out that the stock market isn't a particularly good predictor of future economic growth because there's so many things going on. And in my dissertation, I looked at the bond market. The bond market had many advantages. For example, the cash flows are known. Dividends aren't known. The maturity is actually known. For a stock, you don't know what the maturity is. And for the bond market, at least for the treasury bonds, it's relatively risk-free, whereas in the stock market, risk is all over the place. And that's why the stock market has so many false signals in terms of recession prediction. So I came up with this model that inverted yield curves actually had information about future recessions. It's firmly based upon economic theory, which was very helpful when I defended my dissertation in the late 1980s, because I really only had 4 observations of recessions. And my committee was somewhat skeptical because I could just be lucky on that. They were impressed by a few things. Number one, I got the double dip recession, and other forecasters didn't get that one, or those 2 recessions back to back. They were impressed that it was based on economic theory. They were also impressed that at the time, to get a real GDP forecast, you had to pay for it. There were various companies that did this with very complex econometric models, potentially thousands of equations. The cost of my forecast was the cost of a Wall Street Journal, like 25 cents at the time. So they liked that. And I passed. I got my degree. And what usually happens after you publish an idea, there are 2 things that could happen. Number one is that the idea works less precisely out of sample. And that's the good scenario. And then the other scenario is it just doesn't work at all, that it was a lucky finding and the paper's retracted. So in my particular situation, the model continued to work out of sample, and it predicted the next 3 recessions, including the global financial crisis 1 year before. And then we come to June 30th of 2019. The yield curve has inverted for a full quarter, and I go public saying this inversion is likely signaling a recession that will begin in 2020. So obviously, the model didn't predict COVID, but, and this is really important, we'll never know the counterfactual of what would have happened if COVID didn't actually occur. And at Duke University, we do a quarterly survey of CFOs. And we actually asked them about the probability of a recession. And at that time, in June of 2019, over 50% thought a recession would occur in 2020. And if we increased the horizon to the first quarter of 2021, 70% thought there was going to be a recession. So I think this time around, people actually took that seriously, the yield curve in the summer of 2019. And I do think it might have helped because some companies were being cautious, were watching their cash balances, maybe not willing to take that big loan for an investment project. So when COVID actually did hit, there was some moderation because of the risk management that occurred given the flashing red signal of an inverted yield curve.
So one final follow-up question on the yield curve. So a future Fed chairman might listen to this interview and say, oh, I got it. I just won't ever let the yield curve invert. And now that Europe and Japan have shown me the way for negative interest rates, I'll just keep ramming short rates lower and lower and lower, and we'll never have another inverted yield curve ever again, and we'll never have another recession ever again. Is it really that simple to get rid of the business cycle?
No, it's not that simple. So I said that this idea was based upon economic theory, and it's a really simple theory. So it doesn't take into account the Fed interventions. So I've long said that the Fed likely is just adding noise to this, where they try to do their yield curve control, and that's nothing new. We had that in the 1960s. So my dissertation uses data that goes back many, many years. So it is possible that they could inject so much noise by manipulating the yield curve that the yield curve loses its predictability. So that is definitely possible. Again, this is just like a model. It's a simple model. I said that you could have an econometric model with thousands of equations. This is a single equation. It's a single variable. It's really, really simple. It's interesting. I get criticized on social media because the yield curve model isn't very good at predicting the depth of a recession. So you think about it, that it's good at actually having an advanced signal, let's say a year in advance of a recession. It's really good at predicting the duration of recessions. So the global financial crisis, for example, the inversion was exactly the length of the recession, but it's not as good as getting the depth. And, well, okay, I get 2 out of 3 with a single variable. And look, if I'm doing economic forecasting, yes, I'll use the yield curve, but there's plenty of other information that I would use. It's a good rule of thumb. It is probably the most powerful indicator of future economic activity, but there's other things that you need to look at. So all of these models are just simplifications of reality. Yes, it's 8 out of 8, and yes, some luck is involved, of course. Will it produce false signals in the future? Yes, definitely.